Thank you very much, Anthony. I'm very pleased to be joined this morning by S.J. Rowe. S.J. is from CLSA. He's head of thematic ESG and thematic research for CLSA. And S.J. and I have been working hard in recent months on our CG Watch report. ACGA, once again, is doing the market rankings for the report. CLSA is doing their company research, but doing it in a different way this time, looking more at a sectoral analysis rather than just a company and country analysis. So SJ will explain that. Before we get started, one housekeeping matter for all of you joining us online, and welcome to everybody joining online from Hong Kong, around Asia, and other parts of the world. Please do send in questions, and to send in a question, please use the Q&A function in your computers, in the system. So the Q&A function is for questions. There's also a chat function. And the chat function is if you want to chat amongst yourselves or make comments, or if you want to send a message about a technical issue to any of our operations staff. So that's Mickey or Ida. So please feel free to send Mickey or Ida a question if you have any issues with the recording or the video. Before we get started on CG Watch, I would like to thank, firstly, our research team in ACGA. I won't name them all. You'll have a chance to meet them later in the chat room function. However, they've worked very hard this year. It's been a tough several months doing CG Watch as ever, and I'd like to pay tribute to them for their dedication over a long period of time. Also like to thank the CLSA production team for putting our mini report together. So each of you will have a copy of this in soft copy format. It's our mini report on CG Watch with a preview of the market rankings from ACGA and the CLSA sectoral scores. So big thanks to the CLSA production team for getting this mini report out in double quick time. So just moving on to our presentation. So we're calling CG Watch 2020 Future Promise, Aligning Governance and ESG in Asia. And I'll talk at the end of the presentation about what that theme means. But fundamentally, we feel that ESG and sustainable development in Asia, in order to become successful and effective, needs a stronger governance foundation. I'm going to start by talking about the market rankings in the report and how they've changed. Then I'll talk about the relative performance of the different ecosystem categories in our survey, show you the category heat map of how scores have changed compared to 2018, make some comments on the rising scores overall, and then finish with some comments on how to align corporate governance and ESG more effectively in Asia. Firstly, these are our market rankings for this year. As you can see, the top and bottom of the survey are no fundamental changes. Australia is still at the top with a significant more than 10 percentage point difference between Australia, Hong Kong, and Singapore. Hong Kong and Singapore coming equal second. Last time Singapore came third, Hong Kong pipped it to second. This time they are equal second. And the reason is the difference in their percentage score is less than half a percentage point, so we've made them equal second. Same for Malaysia and Japan. You can see that the difference is less than half a percentage point, so they are equal fifth. Taiwan has improved in the rankings at 62.2%. Then Malaysia, Japan equal fifth. India seventh again, so no change for India. Thailand at eighth, and then Korea, China, Philippines, and Indonesia. And one thing to point out initially is you can see that the change in scores versus 2018 has increased for all markets except Indonesia. And we'll come on to that in a bit more detail shortly. These are how the rankings have changed compared to 2018. In 2018, Hong Kong rose, Malaysia rose, and India rose, and Singapore and Japan fell. In 2020, Singapore has gone up a rank. Taiwan has gone up a rank from 5th to 4th. And Japan has gone up 2 ranks from equal 7th to equal 5th. The markets falling are Malaysia and Thailand. So congratulations to Singapore, Taiwan, and Japan, and commiserations to Malaysia and Thailand. And we'll have a chance to discuss this in more detail during the Q&A and also the chat room at 1 p.m. today. In terms of the relative performance of the ecosystem, so we look at 7 different categories in our survey. 6 of those relate to what we call stakeholder categories, and the 7th is a thematic category on CG rules. And the point of taking an ecosystem approach is, our contention is to have a really sound system of corporate governance. You need to be strong in each of these categories. It's not enough just to be very good in 2, 3, or 4 categories and very poor in the other 2 or 3. You need to be doing well in all of the categories. And this is where the different markets we've covered are performing better relative to other markets or worse relative to other markets. So you can see there are certain themes coming through in terms of where markets are doing well in the region. So you can see several markets, indeed 6 of the markets are doing well in CG rules. Also, 5 of the markets are doing well in audit regulation. So there's a certain similarity there between where markets are doing best relative to other markets. You can see some countries like Japan, markets like Taiwan are doing better in government. Taiwan's doing well in listed companies. Thailand is also doing well in listed companies, but mostly we are seeing the stronger performance in CG rules and audit regulation. In terms of where the weaker performance is, several markets are underperforming in government, and we look at government and public governance. I think it's worth just saying a little bit about this. We aren't taking a complete macro view of government, public governance and politics. We are looking at government and public governance as it relates to capital market regulation and corporate governance. So we look at whether the government has a commitment to corporate governance, whether it has a roadmap for the future. We look at the independence of funding of the regulatory body. We look at whether the government provides strong and consistent political support to the financial regulators. We look at the independence and integrity of the judiciary. We look at anti-corruption measures and so on. Unfortunately, although 2 markets, Taiwan and Japan, we feel, and also Korea, improved in government this time, several markets are underperforming in government, including Australia, Malaysia, India, and Thailand. Probably not surprised about Malaysia and Thailand, given the upheavals those countries have had in the last year. Probably a little bit more surprised about Australia, and I'm happy to talk more about that during the Q&A. Another area where virtually all markets, not all markets, but 7 markets out of the 12 are underperforming is in investors. And this looks at both the work of institutional investors and also retail shareholders. This is a similar theme as in 2018, where investors was consistently the lowest scoring category. And just to explain a little bit about this, although the involvement of institutional investors and retail shareholder bodies has increased in Asia, it's increased from a fairly low base, particularly in relation to institutional investors. So it's only since the global financial crisis 10 years ago that there's really been a strong requirement for institutional investors to take governance seriously across the board, to engage in more serious voting and engagement, and to be thinking about how they need to engage and have dialogue with companies around governance and ESG issues. Of course, the region's had some domestic institutional investors and several foreign institutional investors who've been doing good work in corporate governance and ESG for much longer than the last 5-10 years. But overall, it's really the last 5 years, in fact, that investors have started to become more active. And that shows through in the scores. And another area where certain markets are underperforming is civil society. Civil society is where we look at the role of director education, company secretarial education, the role of non-profit groups, business chambers, the degree to which these entities, non-governmental entities, professional bodies, business chambers, participate in corporate governance, educate their members about corporate governance and ESG, and so on. And you can see several markets are underperforming in that area. So that gives you a flavor for where markets are doing better, where they're doing worse, and particularly where markets could improve. So if they want to get a higher score in the 2022 CG Watch, then the sectors on the right are really where these different markets need to focus. Looking at the heat map, and this shows all the 12 markets we cover and the 7 different categories in our survey. So a green box means the score has risen since 2018. The red box means the lower score, and the white box means no change in score. So you can see that the table is largely green, not too much red, and a little bit of white. So overall scores in the survey are rising this year. I'm going on to talk about that in a moment. But I think this is one of the positives that has come out of the survey this time, is that we are seeing generally improving scores in the survey, and that's not something we've seen in surveys in the past. So what are the reasons for the rising scores? Well, we think there are 3 basic reasons. The first reason is that genuine improvements have occurred in corporate governance in different markets. The second is that we have actually taken a more granular scoring approach this time, and I'll talk about that in just a second. The third is errors from 2018 have been corrected. So in terms of the granular scoring approach, we haven't changed the categories. We still have the same 7 categories in the survey. We still have the same 12 markets in the survey. Under the 7 categories, we have 119 questions. We haven't fundamentally changed the wording of too many of those questions. We've tweaked the wording of some of them, but basically, largely, the wording has stayed the same. And we also haven't changed the 6-point scoring system that we used. But what we have done is, for each of the questions in the survey, we have developed a more granular set of underlying components, typically 4 to 6 for each question, and then we score each of those components and give each of those components a weighting. So to some extent, that system has led to an increase in scores in many markets. But we feel that the reason for the rising scores is fundamentally a function partly of the scoring methodology, but also the genuine improvement across the region. The number of errors we've corrected since 2018, we did make a few. Our apologies for that, and we will talk about that in the more detailed report we publish in January. But fundamentally, we think it's due to the certain methodological changes, but also the improvement in scores. In terms of methodological factors, that really affects 3 categories of the survey in particular. They are CG rules, listed companies, and investors. So we did see generalized improvement in scores across those categories in most markets. So we believe that the methodology we used did have an impact. But it's worth pointing out that across the categories, typically about half of the scores didn't change in 2020. About 25 to 30% of the scores went up in most categories, and about 20% or slightly less came down. So that sort of explains the overall increase in score. But fundamentally, the majority of questions in each category, the score didn't change. We also do, and we want to emphasize this, we do see substantive improvements across all 7 categories of our survey and in most markets. So that could be improvements in rules, it could be improvement in enforcement by regulators, it could be a stronger government commitment to corporate governance, it could be better disclosure, better governance by listed company, more board diversity, more women on boards, more board training, more effort by investors. So we do, in many of the categories in the survey across most of the markets, we do see substantive improvements by the different stakeholder groups. So I don't want to emphasize too much the scoring methodology issue, but I do want to recognize that as a component. And there is some very obvious backtracking in corporate governance in certain markets, and the thing that bothers us a great deal, as many of you know, is dual-class shares. I think the one thing to say on dual-class shares is, whilst we're very disappointed that many markets have introduced dual-class shares now, and the contagion effect that we were concerned about 2 or 3 years ago does seem to have genuinely played out. The good news is that the application of dual-class shares in most places is actually limited to certain types of companies. So in Hong Kong, it's limited to larger companies with a fairly hefty market cap. In India, it's limited to certain types of companies. In Korea, it hasn't come in yet, but when it does, it will be limited to unlisted companies looking to list on the second board in Korea. So I think to some extent regulators have listened to the concerns of the investor community and the corporate governance community and have tried to narrow the focus of dual-class shares. So that's the good news. The bad news is that they have been brought in, and we think that over time this could have a much more negative impact could have a negative impact on markets in Asia if dual-class shares become common. If dual-class shares don't become common, then clearly the negative impact will be limited. And finally, just talking about the theme of the report, Future Promise, aligning governance and ESG in Asia. And essentially the question we're asking is the corporate governance system in Asia really fit for purpose for the new world of ESG and sustainable development and climate change? And our answer would be a reasonably emphatic no. When we look at corporate governance policies and codes, we see very fragmented links between governance, ESG, and sustainable development across most of the region. So to give you some examples of what that means in practice, CG codes, corporate governance codes of best practice, they've been around for a long time, they've been revised many times, but most of them say very little or nothing about how boards should prepare for climate risk. If we accept that climate change and climate risk is the biggest challenge facing economies and societies today, then it would be nice to see corporate governance codes putting a much stronger focus on how companies could be responding to this. CG codes also say very little about how boards should oversee ESG and sustainability reporting, or indeed how they should be upskilling their boards for these new challenges and opportunities. Listed companies also need a clearer and more practical guidance on ESG sustainability reporting. There's a lot of different standards around the world. Many companies are quite confused at what these different standards mean. Most markets in Asia now have their own local standards, so how the local standards and the international standards cohere is a question that needs to be sort of thought through. But there clearly is a need for more practical guidance for companies on this. There's also very little discussion of the assurance of ESG reporting. If we accept that ESG data is very important and very material, then it should probably, some of it at least, should be in the annual report, and that should be audited, or there should be some assurance of the ESG reports, the standalone ESG reports that companies produce. It's a complicated issue, and I think there needs to be a lot more discussion about the proper role for assurance. We also see stewardship codes and corporate governance codes not very well aligned. So stewardship codes talk about the responsibility of investors to be more engaged in corporate governance and ESG, but CG codes say very little about how companies should really engage with investors around this new area. Because if investors are stewards and companies are stewards, then what is the proper relationship between them? How should they communicate with each other? A new area is really the internal governance of institutional investors. That's something that also hasn't received a great deal of attention. Some parts of the region, like Australia, do focus now quite a bit on this, both at the asset owner, pension fund level, and also the asset manager level. But most parts of the region don't say very much. A typical stewardship code will say a little bit about conflicts of interest, but in a very brief and terse way. We think this is an area that is going to become more important in future. As will the quality of investor reporting. That's something that when investors sign up to stewardship codes, they have to report what they're doing. Whilst some investors in the region are very good at reporting, research we've done for CG Watch suggests that the vast majority still are not particularly good at it. And lastly, we see a bit of a disconnect, or a bit more than a bit, sometimes quite a significant disconnect between the green finance and sustainability aspirations, particularly of central banks and security commissions on the one hand, and stock exchanges on the other. Stock exchanges are commercial entities. They often have a conflict of interest in terms of their business and their regulatory roles. And we see much more enthusiasm at the higher end of town amongst the central banks and the securities commissions in terms of pushing policies on green finance and sustainability than we see at the stock exchange level, where often the approach is far more tentative and ambivalent. And in the report, we make a series of recommendations for how we think these areas could be improved. And we very much look forward to your questions and comments on the report and in the session today and the chat room later. So without further ado, I'll turn over to SJ, and he will present on CLSA's sectoral analysis. SJ.
Thank you, Jamie. Hello, everybody. This is SJ Rowe, Seungju Rowe. I'm from CLSA, and I am the head of ESG and thematic research. First of all, I would like to thank Jamie Allen and all the members and organizers at the ACGA. It's a privilege to be here, to be able to speak to you today. And we really appreciate from CLSA the continued partnership that we have with ACGA for the almost past 2 decades. So now for the next 10 or 20 minutes, we'll talk about our findings from the sector analysis of corporate governance in Asia. Basically, ACGA takes more of a holistic view on corporate governance issues. It's more top-down driven, whereas our side is basically a lot more bottom-up driven. So our questionnaire, as you can see in the bottom, starts with the 5 principles of corporate governance, and the framework has been designed almost 2 decades ago, and we kept this framework. Starts with over 27 to 28 questions divided into different principles, and you also have environment and social questionnaires. We distribute these questions to all our analysts, hundreds of them across the 13 different markets that we have, and over 1,160 companies out there. And we classify these companies into 13 sector groups. And we've also made decisions to group some adjacent industries together to simplify things a little bit. And as you can see on the top table that, we have largest representation from the consumer in terms of number of companies basis, 217 companies. But in terms of market cap, you can see that the 12 internet, media, and telecoms has the heaviest weighting. It's equal weighted, so the audience ought to focus on the number of companies. And the scores basically breaks down into 2 axes, as you can see. On the x-axis, you have environmental and social score, and the y-axis here, you see the corporate governance score. The audience should focus more on the y-axis because we give 90% weighting to the corporate governance scores versus the environment and social scores in the horizontal. You can see there's a bit of a visual illusion here. But as you can see, the technology ranks number 1, whereas the conglomerates are actually at the opposite end of the spectrum. Actually, materials and capital goods, it's in the middle and at the top. Ranks higher, scores higher than technology in terms of the corporate governance scores alone. But when we factor in the 10% weighting from the environment and social score, they have done materially better than materials and capital goods. So technology comes out as the winner. Conglomerates are actually at the opposite end, and you also have power and utilities at the bottom, followed by hotels and leisure. And if we look at the changes from the previous edition in 2018, you can see that there's not a lot of changes in the top segment as well as the bottom segment, but there are indeed changes in the middle. So we have autos, which have climbed 4 steps compared to 2018. So there's financial services and insurance. Consumer is actually in the center line, maintaining the 7th position. And you also have energy and property, which have slipped the rankings. Just to look at the changes a little bit more, you can see in general, on average, the entire companies, broken down into 13 sectors, have improved their scores by about 7.2% compared to the previous edition, which is a message that we've also seen a general improvement in the corporate governance broken down by the sector, which is similar to ACGA's finding. And the principle that have improved the most from the previous edition, as you can see, is actually independence by about 13 percentage points, and followed by the responsibility, which have increased about 10%. Responsibility here basically refers to whether the management's interest is aligned with the listed company, and there has been no sort of related party transactions that has harmed the minority interest, minority shareholders' interest. And the sectors that have shown the most improvement is, as you can see on the left-hand side, finance and insurance, followed by power and utilities, materials, industrials coming behind. And at the opposite end of the spectrum, we have conglomerates, which have actually declined scores versus the previous edition, and hotels and leisure as well. It is actually no surprise that these underperformers actually show as the one that who has ranked in low in terms of the absolute score as well. Yeah, just to look at the absolute scores by the different sectors on the row and different principles which at the column level. And you can see that the independence, even though in the previous slide that has shown that the most improved principle out of corporate governance, it is still the most sort of underperforming and the lowest scored principle in terms of the various issues. And our analysts have basically scored that the Asian companies do fairly well in terms of fairness, whether you have your ownership of the stock company equals to their voting rights, and there's a proper remunerations, and the interests are basically aligned as well, and as well as the response, as well as transparency in terms of whether your disclosures are on time, and the majority of the company's dealings have reported and fairly and accurately, and there hasn't really been fraudulent accounting issues. But on the other hand, independence continues to score low in the spectrum, and this is where it is quite interesting because when we specifically asked our analysts whether the company have a bit of a diverse board composition, as you can see on the left-hand side, the scores have almost unanimously have increased compared to 2018. So you have started to see more gender diversity in the board, and you have more external auditors representing the overall board composition. But when we ask on the right-hand side the questions to analysts, whether they think that the board is truly independent and the non-executive directors on the board acts a genuinely independent way, it is quite interesting that the majority of the sectors, the scores have declined compared to 2018, suggesting that the company have acted in a way to improve their diversity of the board and independence, but there is a bit of a skepticism surrounding whether it is actually working truly independently. And I think that's sort of challenges and the potential that we have on the issues surrounding the independence. Next, we have also looked at the top 10 scorers and top 10 improvers by different sectors. And we basically just summarized where do these top 10 scorers and the top 10 improvers actually come from by countries. And it's interesting that we see almost half of the 130 companies and the top 10 scorers are coming from Australia. So if there's any Australian audience out there, big kudos to you. But another interesting thing that you can see is the yellow bar, which is how many companies in different countries have produced the top 10 improvers. And you can see that the big bar from Korea. And this is something, I guess, it gels with ACGA's finding that we have seen Korea's score improve the most. And just to look at some of the standout sectors, first of all, the tech is obviously in the top of the chart. And on the right-hand side, you have a basic scorecard. You can see they do fairly well in all these different 5 principles of corporate governance. And the fairness score is the highest. But you can also see that the independence is the one that is most underperforming. And there's a gender diversity issue here. And there's generally a lack of active board activities in the technology, which they need to kind of improve. And also, in terms of the top 10 scorers, you can see that Infomedia, Technopro, this bottom left, which is sort of IT consulting and the SaaS service companies, not the traditional technology hardware companies ranked at the top, but amongst the bellwether stocks, we have TSMC in the top 10 scorers, as well as Infosys and Tata Consultancy in India, which usually scored highly throughout the history. I guess the most interesting thing out of this slide is actually we see Samsung Electronics in second ranked in the top 10 improvers. And this is going to be a theme. And then the common theme that we've actually found out of this analysis is that a lot of Korean conglomerates have actually started to improve their corporate governance, given the way that the political situation as the regulatory improvements and the companies genuinely started to fix the long-lasting issues in the corporate governance. And you can also see that there's a SK Hynix and LG Display there as well. And even SFA, which is the top ranked in terms of improvers, is broader Samsung family and the supplier of the Samsung as well. So that suggests that there is an improvement in the Korean conglomerates, and our team just produced a big report on this theme as well. But on the opposite end, we have conglomerates, and in terms of scorecard, we can see that they generally score low across all these different principles. But as you might have known, that the conglomerates have structural issues that makes them very difficult to do well in our bottom-up scores. Because if you think about it, they have no core focus in the business that they actually engage in. And investors are often really not sure about what's the hurdle rate and what's the criteria of getting into the new businesses. Some of these conglomerates are owned by families or even by government. And that means there is a degree of heavily regulation, as well as they are having an issue with the government in some sort of. So that makes the conglomerate structure difficult to score highly. And then as you can see, that it scored the lowest in terms amongst all the sectors, as you can see on the top left, that they, in terms of related party transactions which harm the interests of non-controlling shareholders, they scored the lowest. But that doesn't mean that there is actually a conglomerate which does very well in terms of corporate governance score. As you can see on the bottom left, you have KHI from Japan, and Larsen and Toubro from India scored very highly in terms of the score. And there are improvers, no surprising, there's Samsung CNT, which came up again reflecting the chaebol sort of corporate governance improvements theme there. And the next one is the most improvement side in the finance. They have dramatically improved out of all the sectors in terms of independence. I guess the key risk, the key issue for finance in the corporate governance is always going to be how they manage the systematic risk. And I guess they've started to realize that improving the independence of the board is one way to go about it. So top 10 scorers, the Magellan and HDFC from Australia and India is up there. And improvers, we have a China Merchant Bank in China showing up as the company that has most improved in this field. We picked the internet media telco as one of the key highlights in terms of underperformance. So Jamie have actually touched on this before, but when you look at the Asian internet stocks and their IPOs since 2017, including the secondary listing. And there are 22 of them. More than 70% of them had the dual-class share structure. Partly because it was sort of a culture that started by Google in 2005, and these companies followed that, and partly because they were allowed to do so in the exchanges such as Hong Kong, Singapore, and Shanghai. But it's also interesting to observe that this doesn't mean that the dual-class shares actually underperform. So actually the companies that had the dual-class share structure have done much better than the companies that doesn't have the dual-class structure. So for now, because of the tremendous growth in the internet and digitization that is going on around the world, investors are willing to kind of put these issues a little bit aside. But in terms of pure corporate governance perspective, if you think about it, they have a dual-class share. There's a bit of uncertainty or complications around the way the government is structured, way the organization is structured in terms of VIE, and you have rising regulations. And also this sector analysis includes telcos, where telcos obviously are regulated in terms of pricing, and some companies are owned by the state. So there is a reason why this sector actually underperforms. So with that, I would like to sort of conclude my presentation with more of a positive and optimistic tone. We've obviously seen a lot of huge fund inflow into emerging markets that are ESG and SRI theme basis year to date. And we've also kind of checked out of all our 1,162 companies and grouped them into 5 different buckets in terms of their corporate governance score. And we've seen that the top quartile in terms of corporate governance score have outperformed the bottom quartile of the corporate governance score by about 9%, which kind of suggests that yes, good corporate governance companies actually do tend to outperform over the long-term period. And we've also checked that sort of logic using the external third-party market data, which we subscribe to Arabesque, S-Rate. S-Rate provides 5 years worth of scores of any companies in terms of the E and S and G. We've selected a few companies that are in the same sector and same countries and see whether the company with a better corporate governance score are able to outperform the other one with the lower score. And indeed, it kind of shows that there is a positive relations between there as well. And on the right-hand side, this is actually looking at the performance of the good score companies versus bad score companies, broken down into E, S, and G. And definitely on the governance side, there is a correlation, or at least data that suggests that the good corporate governance company continue to outperform the ones with low corporate governance scored companies. Finally, I mean, this is another sort of interesting observations that we had. If we just group all these companies in terms of top 10 scored companies and top 10 improvers and look at their 5-year share price performance, this basically shows that the champions, so top 10 scorers, have outperformed the top 10 improvers on a 5-year period by about 56%. And the top 10 companies have actually increased their share price, doubled their share price in the past 5 years. And if you consider that the MSCI AP index have increased about 67% during the same period, they've also beat the benchmark. But I think another interesting conclusion that we can draw from this, if you see on the right-hand side, is that if you just look at the past 1 year performance, it is interesting that the improvers have outperformed the champions slightly. So we can make an argument that investors do reward companies that are willing to improve their scores as well. So with this, that's basically end of my presentation. But we would like to just highlight that we have a full detail and full analysis will be coming and published in the early 2021 as well. So do please stay tuned for that too.
Great. Thank you, SJ. We've had some questions in, and so online delegates, please continue to send in questions. And what we'll do is we'll start with the online questions first, and then SJ and I will have some further discussion about different aspects of our research. But please do keep the questions coming. The first question is from William Ng. of HSBC Global Asset Management, who asks about why India's investor category did so well relative to other markets in the region, and what are the reasons for this. So William, thank you for your question. This is a good question that we'll pose to Shamla Gopinath during the chat room from 1 to 2 p.m. today, but I'll give you, William, just an initial response. One thing I should say is that if you look at the detailed category scores in our survey, you'll see that the two markets that do really well in investors are Australia and Japan. And there is a fairly significant percentage point difference between their scores and then the next two markets, which are India and Korea. But we wanted to highlight India and Korea in this regards because there has been, some significant improvement in the investor category relative to other markets. So one of the factors in India is that for many years, domestic institutional investors have been required to vote their shares, have been required to disclose how they vote their shares. And this has generally catalyzed, greater engagement by domestic institutions in that market in governance issues. So you've seen some interesting company cases where investors have become much more involved. Also, for several years, India has had an insurance code, stewardship code, that was from the Insurance Regulatory Authority. So that's for insurance companies, insurance investors. Then the pension fund regulator in India brought out a stewardship code for pension funds. And more recently, late last year, SEBI, the Securities and Exchange Board of India, brought out a new stewardship code for mutual funds in India. And one of the interesting things about the SEBI code, or one thing I find interesting about it, is that it's one of the few codes in the region that actually tries to give a little bit of practical guidance to mutual funds on managing conflicts of interest. Most stewardship codes in Asia very much draw on the UK stewardship code of 2010, 2012, and that addresses conflicts of interest, but says basically investors need to have a policy on managing conflicts of interest and say something in their stewardship reports about how they manage conflicts. But there isn't really much practical guidance. And the SEBI code, it's pretty short, but it does have some practical guidance as to how investors can change their organizational structures to think about managing conflicts of interest internally. So those are some of the reasons why India has done well in investors. But it's interesting that those two markets did well, relatively well on investors. There's still quite a lot of room for improvement in both India and Korea, and also room for improvement in Australia and Japan, by the way, because the investor scores still are relatively lower than the other categories in the survey. But SJ, it's interesting that India and Korea in your survey, also in terms of most improved companies in those markets, are among the most improved. So could you talk a little bit more about why India and Korea in particular have the largest number of most improved companies?
Yeah, but just to clarify, these are sort of top 10 companies. So we just looked at the top 10 companies in terms of improvement. So it is a relative scale. So it doesn't mean that these improvers actually have a high scores. And because if your absolute score is lower, sort of any sort of increase in these scores could actually show up as a high improvement in terms of percentage terms. But with that said, I guess the Korea side, we did see a lot of Samsung and chaebol-related companies improving their corporate governance in terms of splitting the chairman and CEO role, which has been announced by the J.Y. Lee himself. And because Korea is very driven by these large companies, once they start to improve, then all the companies down the supply chain tend to start to follow. We also have exchanges which doesn't really allow dual class shares, so some of these internet and media companies have no such kind of issues. And I think that's one of the reasons why I think the Korea we have seen a big improvement in these companies. And then I guess that's a similar. I think India we have to look a little bit more detail, whether it be just because there's a large amount of coverage and so that there is a statistical chance that there are more companies that show up in the top 10 than the rest of the others. but it could also be, we just have to frankly say that it could also be that our past score might actually had a bit of an error, because we did also have a bit of a turnaround in our research team in India as well. That could also be part of the explanations as well.
Thanks, SJ. Very honest answer. We've had another question. This one is from Ziwei Go of Fullerton Fund Management, and it's about which countries and exchanges are seeing an increase in dual-class shares. Is this more specific to a particular sector, e.g. technology or disruptor companies, rather than traditional industries? Thanks, Ziwei, for the question. So to give you a bit of background on dual-class shares in Asia, and then I'll ask SJ to comment as well. It really started with Hong Kong and Singapore a few years ago, looking at trying to bring dual-class shares in. Singapore really to boost IPOs in its market, Hong Kong really to bring back to the market here companies, PRC companies listed in the US, the big tech firms like Alibaba and so on, JD.com. And so Hong Kong and Singapore both moved on this in 2018. Singapore hasn't had very many or any IPOs on dual-class shares. Hong Kong has had several, and they've all been the bigger tech firms. So we had Xiaomi, we had Meituan Dianping, we've now, in secondary listing, have Alibaba, JD.com, several others. So it's started really by Hong Kong, and it's really focused on the tech sector, not the traditional industries, because the rules are written in such a way that you need to have a sizable market cap to be able to list with dual-class shares. Also, you need to be a quote-unquote innovative company, and the listing committee does have some leeway as to how, whether they feel a company is truly innovative and deserves dual-class shares. And to clarify, it's the rule in 2018 was focusing on dual-class shares for the founders of companies. What happened then was China brought out its new Star Board with very similar rules as the ones Hong Kong brought in 2018. So China is encouraging the listing also of dual-class shares. So the main competition right at the moment in the region is between Hong Kong and China, and very much getting the secondary listings or listings of the big tech firms from China. So it's a fairly limited group of companies. That's the good news. The bad news is we just hope this group doesn't grow too large in future and start. Our real concern in ACGA is when we first had the debate on dual-class shares 4 or 5 years ago, was if you bring in this capital structure and existing listed companies start adjusting to dual-class shares, or a lot of new listed companies bring in dual-class shares, then that could have a negative and systemic impact across the market, which could drive down valuations and confidence. So far, fortunately, it's been focused more on the tech sector. Korea is also thinking of bringing in dual-class shares, but as I mentioned, that hasn't happened yet. And as I mentioned, the focus will be limited, at least initially, to unlisted companies looking to list on the KOSDAQ. So that's the sort of the broad overview of dual-class shares in the region. But SJ, I noticed, interestingly, in your table on basically the different categories you look at in your survey, which categories scored better, which scored worse. For fairness, you have the tech sector actually scoring quite well, but then you have the internet sector scoring much worse. So it might be worth clarifying that in your survey, when you talk about tech, you're not talking about internet companies. When we talk about tech, we're thinking largely of these internet companies doing online business. So perhaps you could elaborate on that a little.
Yeah, definitely. So you already covered most of the arguments there. But yes, I mean, it's very specific to internet and tech. In our sector categorization, is more about hardware as well as IT consulting. These two forms our technology sector group. Whereas where a lot of the dual-class shares are related to internet, which kind of, I think, is a culture that started off by Google IPO in 2005. And their sort of argument, and this is sort of argument for dual-class shares, has always been about protecting the vision of the founders and protecting the vision from the short-termism of the market and some of the investors' base. And I think that might actually hold true for certain extents, because I remember, I think back in 2000s and in those period, we never understood how Google's advertising revenue actually works, how the search advertising actually works. And I think there has been a complaint about Google paying too much for the YouTube acquisition, and what are the point of investing in Android. But these investments turn out to be a long-term winner for Google as well. So I think there is a certain truth in maybe dual class share has a function. But I guess the question now is, we are already kind of like into 2 decades of the internet boom. And is it really difficult for us to understand the vision of some of these companies? There might be a bit of a debate surrounding that issue. But again, I think it's very confined to the specific culture of the internet listing as well as China. We don't really see these in these internet companies in Japan and Korea and India.
Thanks, SJ. We've had another question. This one is from Karine Hearn of East Capital, another ACGA member. Thanks, Karine. The question actually, I think, SJ, I'll turn this to you first. Which criteria do you use to define what makes a director truly and genuinely independent? So how do you think about that at CLSA?
Well, I mean, this is, I think, is pros and cons of our approach as a more of a bottom-up sector equity research house. And we deliberately leave this question to our analysts, and because we are also trying to kind of extract their insights of whether they actually think that the board is truly independent. Well, there's definitely something that we could easily check the boxes in terms of the diversity, as well as the percentage composition of the board represented by the external auditors. But we do leave that as room for interpretation for our analysts as well, hoping that investors would actually get in touch with us in terms of what were the sort of the thinking behind the qualitative interpretation that we had on this, true independence of the board.
Karine, I would say one factor that makes a director truly and genuinely independent is whether they really have the character and experience and authority to really bring to a board their own thinking on a topic, and to do so in such a way that isn't seen as particularly overtly confrontational or difficult. I think if a director is seen as that, then they probably will serve 1 term and no more on a board. I think it's an extremely difficult job to do, but you do clearly need to start with people who, men or women, who have genuine experience, know how to operate in a board, and are able to talk to the controlling shareholder and other directors in a way that is seen as constructive, whilst also being independent. And I think that's a balancing act that many directors find challenging to achieve. But we would also say one of our bugbears in Asia is that the definition of independent director is, we think, still quite weak. We've had 20 years of corporate governance reform in the region, yet still you see rules, listing rules or codes of corporate governance that define independent directors as people who could have been an executive of the company 2 or 3 years previously, or could have been the auditor of the company 1 or 2 years previously, or could have been a legal or financial or professional advisor of the company just in the past couple of years. So, within the context of concentrated ownership and state ownership in this region, which is the dominant corporate structure, to say that somebody after 1, 2 or 3 years can genuinely be an independent director and can genuinely express an independent view that's different from the controlling shareholder that was previously their employer or one of their main clients. We don't really think that's all that credible in this region. So, we have been pushing an ACGA for tighter rules, more principles-based rules on independent directors. Cooling off periods have been rising, but we still think that they're relatively low and not that effective in the region. So, to counter to that, people will say, well, there just aren't enough independent directors. You have to start somewhere. Markets, the pool of candidates is small. I mean, all of that is true to an extent, but I mean, there is a demand and supply issue here that if companies genuinely don't have a demand for genuine independent directors, then the pool always will remain small. So I think a large part of it starts from the demand of companies for people who genuinely have something different to offer boards. And that's where we hope the whole focus now on board diversity and also gender issues comes into play. We have a very difficult question from Prue Bennett of Tawari Consulting, and Prue, as you all know, was formerly head of stewardship for Asia at BlackRock, and Prue's also a council member of ACGA, so thanks, Prue, for this extremely difficult question. I would like to pass it over to SJ, but I'll probably have to have a go at it first myself. Prue says it will always be difficult for institutional investors to influence Asian companies on ESG issues, particularly governance, due to the dominance of state and family-controlled companies. Voting and engagement can have little impact as the voice of institutional investors is often ignored. The same can be said for a divestment strategy. How is this issue resolved? Well, thanks, Prue, for such a difficult question. I'm not sure I'll give you a fantastic answer, but I'll have a go, and SJ, feel free to join in as well. But I think there isn't an easy answer to this. There's no quick solution. I think many of the trends taking place in the region are broadly positive. I think the focus on institutional investors having to play a stewardship role really is fundamental and a bit of a game changer. I remember when we started ACGA 20 years ago, investors really weren't in the corporate governance game at all, except for a very small number of very dedicated institutions. So the picture today is vastly different from the picture even 10 years ago, I would say. So I think stewardship codes have had a significant impact on investors, and I think they are starting to have an impact on the relationship between investors and companies. So again, we are seeing more engagement between investors and companies, and I think a higher quality of engagement and more frequent engagement today than we saw even 5 years ago. So I think the broad trend is positive, but clearly it's still very difficult for many investors to have the sorts of meetings they want to with companies. And this is one of the reasons why we feel there needs to be a stronger connection between stewardship codes and corporate governance codes. That if you tell investors that you are a steward of the company and you have to engage with companies and you have to take your governance responsibilities seriously, those investors then have to be able to talk to companies. If the corporate governance code says nothing about stewardship, then the message to companies is somewhat, I think, contradictory and ambivalent. Do companies really have to take these investor stewards seriously? If they did, why would companies, just be sending their IR teams to talk to investors? Which is no disrespect for many of the IR teams in the region. Some of them are, very experienced. But clearly, investors want to be able to talk not just to the investor relations department, but also to senior executives and directors, and particularly independent directors. They want to have an elevated discussion. So I think there needs to be more guidance to companies and more requirements to companies to engage in that genuine dialogue. That's not going to solve all the problems, but clearly if there is more focus on what companies should be doing, if the pressure on investors to be stewards continues. And also I think, as I mentioned, the internal governance elements are important, because in the same way that it's very difficult for companies to respond properly to ESG risks, opportunities, climate change, if they don't have the internal mechanisms and organizational structures. I think it's very difficult for investors also, to really play their proper role if their ESG team is just one person, or they have one person covering China, or one person covering Korea, or indeed two people covering Asia. Investors need to think about, the proper budgeting and resourcing of this role, and it's time-consuming, it's difficult, and you need experienced people. And so without the proper governance system within investors, the allocation of resources isn't going to be sufficient and isn't going to be sustained. Anyway, I hope, Prue, that provides a couple of thoughts. I'm sorry we can't debate this issue live. I'm sorry that you can't sort of respond verbally through the system, but thanks for your question. SJ, any thoughts about how?
Well, yeah. I guess I come from very sector analyst background, because I've been looking at the sector for the past 13 years. And the one that I feel, I'm relatively new to this role and I'm still learning, catching up. But at least when I actually engage with the companies, there's this increasing sign that the management is listening, or they're forced to listen. And we started to see some of these commentaries around how they want to change and how they will do, at least show up in these earnings conference calls recently by these larger companies. And there are obvious signs that some of these engagements have worked. For another example, sorry, I'm from Korean background, so I use a lot of Korea example. But Samsung, for example, they decided to shut down their investments in going into coal plants in Vietnam and different parts, including Capco as well. I think that's all a function of investors constantly engaging with these companies. And we've seen such cases in Japan as well, Sony, Canon, Nintendo, some of these companies have now started to listening to investors' long-term demand for better corporate governance, capital management. So I guess, that's probably one thing that I can add, that from the bottom-up level, I do see more changes. I might be a bit naive here, but that's how I actually feel I get into the job.
Thanks, SJ. Another question from Arnaut Van Ryn of Robeco in Hong Kong. Arnaut says, you mentioned exchanges are lagging. What more do you expect exchanges to do? A good question, Arnaut. I think in a nutshell, we would like to see exchanges playing, if they can, a more independent role in terms of enforcement. Most exchanges are for-profit entities, whether or not they're listed or not. When you read the finances of exchanges, it's very clear that they're focused on making profit. And most exchanges have annual reports and the information's there. So the question is, if they're really focused on making a profit, are they really focused on investing effectively in the enforcement function? Exchanges are a business. They're a monopoly business in many markets, but they also have a regulatory role. And to play that regulatory role requires proper resources, proper investment. Yet it's very difficult. One of the questions we ask in our survey is, are stock exchanges investing adequately in their enforcement capacity? And to be honest, it's very difficult to answer that because often the data isn't there. You see generalized information on operating expenses, but often it's not broken down into what they're spending on enforcement versus other areas of their function. So we would like to see exchanges, if they are going to retain a regulatory role, and there's a strong debate as to really whether they should or how much of a regulatory role they should have, but to the extent that they continue to be regulators, we'd really like to see them playing a much stronger regulatory role, being more transparent about what they're doing on enforcement. Some exchanges are very good at disclosing their enforcement work, both in terms of overall statistics and individual cases. Other exchanges are far more opaque. So more disclosure around the resources, more disclosure around the enforcement. But then on the policy side, it would be great. We do have consultations in the region, but to be honest, some of the consultations are a foregone conclusion, even if they're very detailed consultations and you have 2 or 3 months to respond. You often pretty much know how the consultation will come out. So to have a consultation process that is genuinely has integrity and is independent is important as well. So those are a few ideas for what exchanges could be doing. We have a question from Nadia Zainuddin of the Securities Commission Malaysia. Nadia asks, could you share observations on the performance of markets in relation to enforcement, in particular markets where scores dropped this year, Malaysia, India, Indonesia? Nadia, I will let my colleagues in the chat room later go into more detail, but to some extent scores dropped either because we saw an impact of political changes in a market. To some extent scores dropped because, as I mentioned, we're looking at disclosure of enforcement work. Some markets are not. Malaysia actually is good at disclosing its enforcement work. Some other markets you don't get as much information on that. Also, some markets you don't get much information, as I mentioned, on the resources they're putting into enforcement. But I think this is an issue that we'd probably pick up in more detail later during the chat room function. Another question from Corrine Hearn at East Capital. Where in Asia do you see tangible improvements in terms of companies and boards integrating SDGs, Sustainable Development Goals, in their strategies, KPIs, incentivization structure, and reporting? So where do you see tangible improvements in terms of SDGs being incorporated into strategies, KPIs, incentivization structure, and reporting? So SJ, I might turn this question to you.
Well, I think, I'm not entirely sure about it. When I looked at the sector basis, I mean, these reporting standards, I guess, is not part of our questions. But there has been, there's been general improvement in terms of the transparency. And basically, our questions are designed to ask the companies and the analysts whether they feel they have a better access to management, and the disclosures and financial information are up to a point and precise, and they won't hide details. And that's where we've generally seen the improvement, I think, across all the markets.
Corinne, we don't look in great detail at SDGs, but I think clearly in Japan there's quite a lot of focus on including SDGs in reports. I think we see some of that also in Korea. We see some of it in leading companies in other parts of the region, Australia, a couple of companies in Hong Kong. But to what extent companies are truly integrating SDGs into their strategies, KPIs, I think there is a broader question: to what extent are companies really looking at material ESG risks and linking that into their businesses? That is an issue that we did look at in our company survey in CG Watch. And we took 15 large cap companies from the top 50 in each market and another 10 mid caps. And we found a very wide variation in the extent to which companies are reporting on their material ESG risks, whether they recognize these material issues as risks. We started by using the SASB, the Sustainability Accounting Standards Board, indicators as a sort of a consistent benchmark to judge how companies were reporting against materiality. And we did find some companies in Asia doing extremely well. So I think genuinely the region does have some excellent companies in this regard. And those companies typically will start reporting on TCFD, that's the Task Force for Climate-Related Financial Disclosures. But even amongst 15 of the largest large caps in each market, we see a very wide variation in the incorporation of metrics, materiality issues into their strategies and KPIs. Okay, we have a couple more questions. Thank you to all your online delegates for sending in so many questions. It's great. Another question from Malaysia, this one from Sunita Rajakumar. And Sunita is going to be speaking on December the 16th with Ben McCarran and Karina Litvak in our Climate Ready Board webinar. Sunita is from Climate Governance Malaysia, and she asks, many businesses are not prepared for the climate emergency, and many will go under. Does climate resilience, governance readiness deserve a criteria of its own in your assessment? Thanks, Sunita. I think we would say yes. I think we would like to see, particularly in CG codes, we would like to see a real focus on climate risk and how boards should be thinking about it, how they should be managing it, how they should be changing board composition to deal with it. You are now starting to see climate change as a discrete, separate issue within ESG reporting guidelines. So to that extent, there is guidance to companies on reporting around climate change. Several markets are either recommending companies follow the TCFD requirements, or they're incorporating their own climate change KPIs into their ESG reporting guidelines. But we do think that this needs to be elevated, and we do think there needs to be, it's not enough just to have something in an ESG reporting guideline on climate risk. There needs to be something, I think, in corporate governance codes as well, to really get companies moving on this, because I think there is a mixed signal being sent to companies. SJ, do you have any comments on that? Okay. And then we have a question from Shuwei Tang of Ziding Proxy Shareholder Services in China. Shuwei asks, many countries and districts have already set up their own stewardship code. Some of the code was mandatory, made by regulators, and investors have to comply with the code, while some are made by third parties and associations, and investors can choose whether to comply with it or not. So, if China adopted its own stewardship code in the future, which way would be more practical here? Any overseas observations or experience? Shuwei, I think this will be a good question for Nana Lee to respond to during our chat room after lunch. But I would say that we do think it's important for a stewardship code to have a proper entity, domestic entity, publishing the code and supervising, or what we call grandfathering the code, to make sure that the code is revised and updated as necessary. In some markets, that could be a non-governmental organization. However, I would say in most Asian markets, it probably is more effective if the stewardship code supervisory agency is a government entity. My sense in China is that it would probably be better if this was a government or government-related entity, really to send a strong signal to investors that this is important. But I leave it to Nana to elaborate on that during the chat room later. Those are the questions that we've had from the online delegates. Thanks very much again for all those really interesting questions. I hope we've had a chance to, I hope we've answered them to some degree effectively for you. And we've got a few minutes left, so I've actually got a few questions for SJ. He might have a question for me, but I think the first thing we probably need to address is the issue of Japanese companies, because if you look at the mini report, you can see that CLSA's analysis of Japanese companies is quite a bit more positive than our analysis. In our analysis, one of the sectors that went down in score was actually companies. So I think we should probably address that issue head on, and I'll invite SJ first to talk about how they view Japanese companies.
Yeah, again, I think the specific sort of observation lies on the top 10 scorers and top 10 improvers. And actually Japan has one of the larger number of companies being covered. So there is a higher chance that we see more Japanese companies in the top 10 ranks as well. That said, that's similar to India, but there have been some genuine improvement in the Japanese companies that we observe, that I've mentioned the case of Cairns, Sony and Nintendo now finally really started to think about the ESG issues as well. And also you had the case of Kao, which always has been very emphasizing the ESG as the core value of the firm. And then it also could be issues where the Japanese analysts tend to look at their stocks throughout the years, and they kind of like look at it in terms of the progression compared to their tenure and the experience of covering the stocks. So any sort of marginal improvement would actually show up in the improvement in the rankings. And they don't really have this luxury or capacity to look horizontally outside their own market and sector, which I guess our scores from the top down, or looking at across the different sectors and countries, actually capture. It's more like, if you're a wine drinker, you kind of like only comparing the vintages of the wine that you drink, not necessarily trying different wines in your different regions to make the comparison. I think that's possibly one answer for why our Japan scores bottom up actually scores quite high, at least in the top 10.
Thanks, SJ. And the reason why in our survey Japanese companies aren't doing quite so well is we certainly recognize there's been improvement over the last 5, 6, 7 years in Japan, since the stewardship code came in 2014 and the CG code came in 2015. And we do recognize there's been a big increase in the number of independent directors. We recognize there's been improvements in dividends, share buybacks. Corporate governance reporting in Japan has certainly improved in volume and gradually in quality. But what we're doing in our survey is actually not measuring sort of the number of independent directors. We're not looking at how dividends have changed. What we're looking at really is how companies are disclosing against certain financial, governance, and sustainability questions. And we're doing a sort of a deep dive into different aspects of corporate governance and reporting. So looking both at disclosure and to the extent disclosure actually reflects practice on the ground. So whilst we recognize there's been an overall improvement in Japan, when you actually drill down into more granular governance issues such as board evaluation, executive remuneration, director remuneration, policy and disclosure, director training, a whole range of issues, board committee reports, audit committee reports, nomination, compensation committee reporting. When you delve into many of these issues, you actually do find that despite the fact that overall corporate governance reporting has improved in Japan, the level of reporting on some of these more specific issues is actually well below what we see in other markets. And it is worth emphasizing that we apply exactly the same methodology, questions and criteria to every market we're looking at. And we start the process in ACGA by doing our individual markets, and then we come together as a team at the end and we discuss, debate, and we make sure that the scores across the region are consistent, and we spend an awful lot of time doing that. This year normally we spend several days together in Hong Kong doing it. We couldn't do that this time because of COVID, so we had numerous calls, and those calls went for more than 2 weeks. So it's a call for 2 hours every day for more than 2 weeks. So it's a pretty rigorous, disciplined process. So we aren't, the scores we do think are relevant for each market. Great. We have a couple more questions here, but since time is short, I think what I'd like to do is leave these questions for the chat room with the ACGA research team later. But thanks to those who have sent in those questions. And I did want to just ask SJ a couple more questions about their survey. And SJ, you had the really interesting graph at the end there showing the correlation between better corporate governance, ESG, and share price performance over a 5-year period. So there's a very nice correlation there showing that the better the governance and ESG, the higher the share price performance over a 5-year period. But I think you also said that over a shorter term, you didn't find such a strong correlation. So I think you would argue that in the short term, other factors perhaps drive share price performance. Over the longer term, you feel better governance really does drive share price performance.
Yes, I think that's definitely one way to interpret it. Well, I guess the share price reflects multiple things. And the 5-year performance grouped into different quartile. If you actually see our results in terms of which sectors have performed well in terms of the ESG corporate governance scoring, then it's tech, it's pharma, and these sectors for the past 5 years have done very well with the sort of big equity rally that we've seen in some of these sectors, and that could be part of the explanations why the first quartile share price performance have done well. But obviously, yes, this is one of the supporting signs that the good corporate governance gets rewarded over the longer term period. And then, but in terms of the short term performance, I was looking at that more in an angle of versus the relative performance between the top scoring companies group and the bottom score and the improvers group. It does suggest that the investors also do reward the improvers, at least in the short term. But again, I mean, it's a short term, so there are a lot more investors, different types of investors participating in these sectors. And some of them, the corporate governance might not really be their strategy at all. So we have a limited sort of enough evidence to kind of conclude that, but at least it's just a one chart and analysis that shows improvers might actually have a chance in terms of linking that into performance versus the top performers.
Thanks, SJ. Well, that brings us to the end of the session. I think that's a nice positive note to end on. So thank you all for watching this morning. Thank you all to the online delegates for your many questions and the ones we haven't answered. we will answer during the chat room, and several of the ones we have already attempted to answer. I'll allow my colleagues who know more about their markets than I do to have another go at answering those, so please do join us for that. We're now going to have a half an hour break to 11 a.m.